Gemma. Oh no. I've been on mute this entire time. This is crazy. I'm such a slops. Thank you, Gemma. Oh my goodness. All right. All right. I got it fixed now. Shout out to the fact that I don't know what I'm doing. Oh my goodness. All right. I'm about to go through the budget again. I'm gonna go through this real quick because I was on mute the whole time. This is why I have too much stuff. All right, this person was making $4,000. I updated this show. Let me share my screen real quick. I updated the show that they was making $5,000. There we go. Boom. Thank God I didn't do the whole stream on mute. I would have been heated. All right, shout out to Jim. I was showing this person making $5,000. I mean $4,000 originally, right? We came down in here. We looked at their budget. Originally, they didn't have any credit card debt, right? They were coming down here, and then boom, they're making this 29.30, right? I'm like, okay, how much money do they have left? They got all this debt, et cetera, et cetera. Then I was like, boom. Well, once y'all come down here and y'all add in your car note, y'all add in, excuse me, not your car note, you add in entertainment, you add in your hair, your nails. I guess it's more of a woman's budget, right? Eating out, all these different type of things. This is where you actually end up screwing yourself as far as living paycheck to paycheck from a budgeting standpoint. Okay, you actually have money left over. Again, you make $4,000, right, and you're spending less than 3,000, so you got $1,000. You got more than 20% left over. But if you feel like you're living paycheck to paycheck, it's because you're forcing yourself to when you come down here and you actually look at everything you're spending. So now you're spending $3,970. And that's why you feel like you only got a couple of dollars, $30 left over. You have no money to invest, aggressively pay off debt, hit your savings goals, et cetera, et cetera. It's because when we look out your total budget or your expenses, you are blowing the entire bag. And Jim, shout out to you for making sure I was off mute. The issue is my mic, like the reader is saying me like, yes, pick up the mic, but I was actually muted in and of itself on here. Let me. There we go. All right, boom. So again, that's it for the budget. The great thing is about the budget is I already have an episode on Wealth Wednesday about the budget, so you guys can watch that one. It's essentially the exact same thing. Again, you need to do your budget to prepare for 2023. All right, I'm about to chop up that audio too because it's gonna be beautiful like the first 25, 30 minutes. All right, boom. Next thing up is going to be again the updates for the IRS changes for. Let's go with the entire actual bracket changes. All right, so I'm gonna share this tab because obviously you know how much money you're right. You're making this income, but how much is it? How much is it being taxed? Oh, I know what I can do. I can do this. It's gonna be easier. Share this tab instead. Boom. All right. Here we go. IRS provides tax inflation adjustments for tax year 2023. All right. So again, the marginal tax rates are 10%, 12%, 22%, 24, 32, 35, 37%. All right. Is this saying the 10% is gone? There we go. The lowest rate is 10% for income single individuals. All right, boom. So how this works in America, we live in a progressive tax system, if you don't know. So as you make more money, it gets taxed at a different rate. So this is saying the lowest one is 10%. So no matter how much money you make, if you make $11,000 if you're single, or 22,000 and you're married, filing joint or more, the first 11 or $12,000 against single or married, filing joint is going to be taxed at 10%. Right, so that's 11,000. Excuse me, that's $1,000 if you make 11,000, and it's $2,000. Excuse me, $2,200 if you make 22 if you're married. My bad, it's 1.1K and 2.2K for that. I'm extremely flustered because I was on mute this whole time. All right, then obviously you can see what it is for 12, for 22, for 24, 32, 35, and 37%. So I was talking. I don't know if it was on a previous Wealth Wednesday or the one before that, saying how some of you are living paycheck to paycheck, right? That budget we just went over. And let's say you're like, I just need a couple of dollars to get by, right? Well, where's that money going to come from? You may or may not be getting a raise at all or whatever it may be. You are going to get a little bit more money. It might not be your first check in January, but likely probably your second check, depending on how your pay cycle works. But definitely by your first check in February, due to these tax rates, then the rates aren't increasing as far as the percentages from the marginal rate standpoint, but the ranges are increasing. So last year, I believe it was 10,000 or 10,500. Let me see if I can find it. Let me see if I can find it. The 2022 tax bracket. Boom. Share the screen instead. So last year, remember, going for 2023, if you're single, your first $11,000 are going to be taxed at 10%. But for this year, 2022, your first $10,275 are going to be taxed. So they're giving you almost another $750 they're going to be taxed at this 10% rate versus how this year in 2022, that 750 over the 10,275 was taxed at that 12% rate. So it's not going to be a quote unquote a whole bunch of money, but if you are living paycheck to paycheck and you need a couple of dollars, you are going to get this when when the year switches over and the ranges increase for these different tax brackets. So to go over them, like I said, if you're single, the first 10,000 is at 11,000. If you're married, filing joint is 22,000. Then 12% is going to be from 11,000 to 44,725. If you're single, then it's going to be from 44,726 because it's like an extra dollar, right? To 95,375 for the 22% tax bracket. 24% tax bracket is going to be 95,376 to $182.99, $0.099. For the 24%, if you're single, then the 32% tax bracket is going to be $182.100 to $231.249, and then 35% tax bracket is going to be $231.250 up to what's that 30% on that? Jesus, up to $578,125. Then everything over $578,125 is going to be taxed at the 37% tax rate. And then if you're married, it's going to be $22,000 for 10%. Then it's going to be $22,000 to $89,450 taxed at 12%. So again, if you're married, essentially the first $90,000 that you make are going to be taxed at an average of 11%, right? 10% plus 12%, divide that is 11%. Because the 22% tax bracket is incomes over $89,450. So in short, $90,000. It's going to be over that. My goodness. Okay. And then for 22% tax bracket, it's $89,450 to $197.50. And then $197.50 to $364,200 for 24%. Then 32% is going to be $364,200 to $462,500. And then 35% is going to be $462,500 to $693,750. And then the 37% tax bracket is going to be $693,750 and up is taxed at 37%. I don't know if we'll be at $1 million before we get out of this decade, but I would not be surprised if we're at $1 million when we get out of this decade. Let me see what it was last year. Last year was 647. The highest one was 693. Hit a $40,000 increase. I know it's due to inflation, but my goodness, almost $50,000. So we might get there. But these are going to be your tax brackets. So most people are going to fall within this range. I mean, obviously and below, but they're going to fall within the 190K and lower range. I think the average household income medium is still in the 60, 70K range. And that's combined, single and married. But most people are going to be in this general range. Tax anywhere, from 12 to 24%. You see this big jump right from 12% to 22%. That's why when you get married, you might see a ginormous increase as far as all you do is change your tax filing status from single to married filing joint on your W-4 is because you're getting so much of your money being taxed at this 12% rate. Again, essentially your first $90,000 tax at a 12% rate versus when you're single, half of, right, from 44 to 95 is being taxed at that 22% rate. So if you're single, you make $90,000, 45K of it is taxed at 22%. You get married, none of it is taxed at 22%. And it drops all the way down to 12%. That's a big change. Don't get married for this increase, but it's something to be aware of. And then let me see if I can find head of household on here. There we go. Talking about standard deduction. Yep, standard deduction for married people is going to be 27,700. Single taxpayers would be 13,850, and head of households would be 20,800. Let me see. I don't see head of household on here. I thought I had a household and single was the same rate. Now head of household is like it's like the Goldilocks, but not like the warm one. It's like it's less than the married, but more than the single. So if you're head of household, you get taxed at a better rate than if you are single, but it's still not as good as the married filing joint one. All right, y'all. So that's what we got for the increase as far as the tax brackets. Now we're gonna get over here and we're gonna look at the 401k changes. All right, again, 401k. It is a section in the tax code. Let me zoom in here. Okay. It's a section in the tax code. It's the 401, Part K, however you want to look at it, part of the tax code. And in short, this is an investment account, retirement account that your employer has to open up for you. And since your employer can open it, it means that your employer can make contributions to it. And usually they call it an employer match. And let's say they offer you a 4% match, but you have to contribute 5% to get the full match because your first 3% is matched dollar for dollar, and then the next percent is matched at 50 cents for the dollar. So you got to contribute 5% to get the 4%, right? It's weird, funky math like that. Or some people might just match you dollar for dollar, up to 10%. It's all different. But for 401k last year, it was $20,500, and this year it's going all the way up. As you can see right here, highlighting this like weird little purple, it's going up to $22,500. Again, 401k, if it doesn't say Roth, the money that you put in is going to be pre-tax, so you'll be able to take this as a deduction. So let's say, for example, you make $100,000 and you want to max out your 401k next year. You're going to actually be taxed on not the $100,000, but the 77,500, right? Because 22,500 of those dollars you're put into your 401k, so it's going to get deducted from your taxes, so you won't be paying taxes on it. And again, your employer contribution does not count towards this limit for the 401k. When I get to the HSA, that is not the case, but I'll explain that when we get there. So we have this increase, right? Income ranges, deductible, right? Okay, then we got traditional IRAs on here. I'm going to do that on another tab with some other changes. Again, as you see, contribution limit for employees who participate. Again, 401k, 403b, that's same most 457 plans. Again, 403b is like teachers, nurses, things like that. And again, thrift savings plan for the government, your TSP, right? 22,500. The limit on annual contributions to an IRA. Okay, I get the IRAs right here. The IRA contributions is $6,500. Again, the limit on annual contributions to an IRA. So this means if you have a traditional IRA and a Roth IRA, you can at most put $6,500 in them combined. You can't put $6,500 in each. So last year it was 6,000, so 3,000 spread. But this year, or excuse me, next year for 2023, it would be $3,250 as far as the most that you can put into your IRA if you do a traditional and a Roth. Again, catch-up contribution limit once you hit 50. And again, for this catch-up contribution limit, I believe this is the year you turn 50. So if your birthday, right, is tomorrow, New Year's Eve, and you turn 50 next year, as soon as, next year hits, you can start putting money towards this $1,000 catch-up contribution limit. And it's not subject to the cost of living adjustment. So it's still at $1,000. So if you're over 50 or 50 and up, should I say, not over 50, if you're 50 and over, as it's saying here, the most you can put is $7,500 into IRAs. Okay. Catch-up contribution limit for employees age 50 who participate. So again, for IRAs, the catch-up contribution limit is still $1,000, but for 50 and over, for 401ks, 403bs, 457 plans, this will increase to $7,500. So that means you can put in the 22,500 for the 401k, and then you can also do that $7,500 increase is for the catch-up contribution. So the most you can put in if you're 50 and over is saying here is $30,000. And if you have a Roth 401k, then obviously that money is going to be post-tax, so you won't get the pre-tax deduction. But $30,000 is a lot of money to invest. And again, that's not including your employer contribution or your employer match. Catch-up contribution for 50 and over for simple plans. So this is a simple IRA, which is not the same thing as a traditional or Roth IRA. It's a 401k type of plan for, like smaller businesses. It's going up to $3,500 from $3,000. Phase out ranges for deducting contribution to traditional IRA will also increase. Taxpayers should review this notice for how that works. So when they say something like a phase out contribution for Roth IRAs, there is a certain amount of money that you can make an income contribution limit. And once you hit that threshold, because I believe, it's not on here, it's on that one. But when I get, I'll explain it more when I get there. But there's a phase out range where once you make too much money, you can't contribute directly into a Roth IRA. There's the same thing for a traditional IRA. However, there's no income contribution limit as far as saying you can make as much money as you want and you can still put money in traditional IRA. However, there is a phase out range saying once you hit a certain income, you can no longer take those traditional IRA contributions and take them as tax deductions. So that's what this is saying right here, phase out ranges. So it's increasing, but they tell you to reference this document, but they don't have a link to it. So sensational. The income phase out range for people making contributions to a Roth. Again, like I said, Roth is the same thing. And then income limit for savers credit, so impact most people. And then the amount individuals contribute. Okay, then the amount individuals can contribute to their simple retirement accounts will increase to $15,500. Okay, so those are the big changes again. For 401k, it's going to be $22,500. And then for the traditional IRA and Roth IRA total contribution, it's going to be $6,500 right here. And the catch-up contribution, if you're 50 and over, is still going to be $1,000 for IRAs. However, for 401ks, 403bs, 457s, TSPs, the catch-up contribution, if you're 50 and over, is going to be $7,500. So for 401ks, the max you're going to be able to put in is $30,000 if you're 50 and over. And then for IRAs, the max you're going to be able to put in is going to be $7,500. All right. Now, right, let's go to the IRAs. Right. I don't know why they don't have links to these things. All right, boom. Here go the phase out ranges I was talking about. Now, when we're talking about your IRAs, the Roth IRA in particular, it goes off your AGI, which is your adjusted gross income, not your MAGI, which is your modified adjusted gross income. In short, not tax advice, entertainment purposes only. Don't sue me, sue your mama. Your adjusted gross income is usually greater than or equal to your modified adjusted gross income. So your modified adjusted gross, your adjusted gross income has stuff added into it that your modified adjusted gross income takes into consideration. So in short, what this is saying is if your filing status is married, filing joint, or qualifying widower, sorry if you're a qualifying widower, but if you are, and your modified adjusted gross income is $218,000 or less, then you can contribute up to the limit. So if you're married, filing joint, one of the benefits again of being married is even if your spouse, right, only one of you works, so you have a stay-at-home spouse, since you're married, filing joint, technically that is y'all's income, y'all's taxable income, you can contribute into the spouse's Roth IRA who does not work. So instead of it being a $6,500 limit, it's technically $13,000 as far as how much money you can put into the Roth IRA. It's still going to be two separate accounts, so it's still going to be a $6,500 limit for both Roths, but it's a total of $13,000. Again, if you're married, filing joint, married, filing separate, that is not the case. So please be wary of your tax filing status. But again, it's saying if it's $218,000 or less, then you can contribute up to the limit. So you're below the phase out range. The phase out range starts right here at this $218,000 to $228,000. So as a phase out range, what it's saying is as you go through these ranges from the 218 to the 228, the amount of money you'll be able to contribute directly to a Roth IRA is going to be a reduced amount. I can't remember exactly what that formula was, but I believe it was $500 or something like that as you go up like $1,000. So if you make $220,000, right? So you're $2,000 over 218, it's a $500 reduced amount per $1,000 you went up. So technically that would be $1,000, something weird little formula like that. It is confusing. It's not confusing. Please consult a tax professional and or investment professional with this because it's not just very simple because the ranges always change. You can see, all right, 2023, things change pretty much every year with the taxes. It does change. Now it's the same, right? If you make over 228,000, so you're above the phase out range, you can put $0 into your Roth IRA. Now remember, the Roth has income contribution limits, meaning once you hit over that income, you cannot directly contribute to it. The traditional IRA has income contribution limits for your ability to take a tax deduction. Okay, so for the traditional IRA, no matter how much money you make, you can put money into a traditional IRA. You just got to worry about if you make too much money, you can't take the deduction because that money you're putting in is going to be post-tax money. But when you file your taxes, you're going to be able to take that deduction unless you make too much money. However, for your Roth, if you make too much money, you cannot put money directly into it. However, as I've discussed before, I've already said this before, as I've already discussed before, the backdoor Roth will allow you to put money into a Roth IRA, even if you're over this 228,000 income limit as far as your adjusted gross income if you're married, filing joint. In short, what is what is a backdoor Roth IRA? What you do is you contribute money to a traditional IRA, because remember, a traditional IRA has no income limits as far as how much money you can contribute to it. Doesn't matter how much money you make, you can always put money in traditional as of the current tax code now. Then what you do is you essentially pay the taxes ahead of time on that traditional, and you roll that money over, you backdoor it to your Roth IRA. So you pay the taxes ahead of time, and then you're able to put the money in the Roth IRA. However, please consult a tax professional on how to do that, or if it makes sense for you. Because remember, there's these reduced amounts. So in short, if it's say it's $6,500, just because you make $220,000 doesn't mean you can't put some money into a Roth IRA. It's just a reduced amount. Okay, always remember that. And again, at the beginning of the year, if you're not, especially if you've never worked with a tax professional, it might be hard to project exactly what your income is going to be. Let's say you're making merely filing joint 150, then you go and get a crazy, job increase, right? As far as pay halfway through the year. And now you're in a situation where you're in this phase out range. There's ways to handle that, right? You got to pay penalties, et cetera, et cetera. But, you got to be mindful, make sure you plan out what your year is going to look like. Obviously, making more money is better. If you make more money, right, taxes, come with this part of the game. But that is something you need to be wary of. If you're already over this $200,000 threshold in your married filing joint, and you want to do a Roth IRA, you can see it's pretty much 218, right over the $200,000 amount that you're earning. All right, then if you're married and filing separate, this is confusing. Can y'all see my face when I did that? It's $10,000, and you live with your spouse. If you're married and filing separate and live with your spouse at any time during the year, your modified AG has to be less than $10,000, and then you can contribute a reduced amount. If you're married and filing separate and you live with your spouse anytime during the year, anything over $10,000, zero. What this is saying, y'all, and this is just like, don't hate the player at the game, but like, don't be married filing joint. That's what this is saying. That's what this is saying. Don't do that. The Roth IRA is not going to be a good option for you. Single, had a household, or marriedly filing separately, and you did not live with your spouse anytime during the year. All right, now I shouldn't have to tell you all this, but please do not commit tax fraud. It says if you live with your spouse at any time during the year. What does live mean? I don't know. You got to look at I'm not a tax professional, but a lot of y'all be living with a lot of people, and you likely, all right. It's saying if you did not live with your spouse at all, you had a household or single, it's going to be $138. So for my single people out here who's getting the bag, all right, if you make 138,000 or less, again, this is adjusted gross income, but let's just think of your gross for simplicity. If you make $138 or less, you're good. $138,000 or less, you can contribute up to the limit. In short, that means you can max out your Roth for the year. That's $6,500 again for 2023. However, let's say though, like I just said for married people, let's say you make $125, right, going into 2023, and you're looking to do a job change. You're gonna be right on that 138, or depending on what field you're in, you might surpass it. And depending on when you get that job, right, you're gonna be in a situation where you might have contributed too much money because your income for the year is gonna be over that $138. So As I always say, all right, I went over with the tax ranges. As you start getting to that 22, 24% tax bracket, the rules change. Because if I switch back over here, right, and I always say that for y'all, again, this 24%, right, or 22% tax bracket, again, 24% if you're single, but more so 22% if you're married. Again, as you're getting up to 24%, if you're married, right, you're getting to that 190, that $200,000 range. And if you're single, you're 95K to $182. That literally translates over to this 218 or this 138 limit for married, filing joint, or single, respectively. So as you start transitioning from that 22 to that 24% tax bracket, the tax laws literally change for you. So that's something you got to be mindful of, and that's why I always say that. And again, for single head of household, single or head of household, or married filing separately, and you did not live with your spouse at any time during the year, the phase out range is $138 to 153. So that's $15,000. And I think, okay, yeah, the formula is going to be on here on how this reduced amount works. And then obviously, if you're single, had a household, or married filing separately, and did not live with your spouse at all during the year, the phase out range caps at a $153. So anything over $153, AGI, no money can go directly into the Roth IRA. You're going to have to use the backdoor method. All right. And then the next thing is going to be, let me see. Let's look at, reduce Roth. All right. So it's saying if the amount you contribute can be reduced. All right. That's how you figure it out. This is probably going to be highly confusing. So subtract from the amount in one, right, your AGI. So if it's 218, if filing joint return, a qualified widower. Then if married, filing separate return, okay, let's find year, $138. Divide the result in two by 15,000, and then 10,000 filing joint return, or qualified widower, or merely filing separate. Goodness, there's so many things, so many conditions. Multiply the maximum contribution limit before the reduction by this adjustment, and before reduction for any contributions to traditional IRAs by the result in three. Subtract the result in four for the maximum contribution limit before this deduction. The result is your reduced contribution limit. Let me click on this worksheet and let me see. This is so much. This is literally the IRS website. There's so much stuff on here. It's insane. This is why you need a CPA. This is too much to go through on this episode. But again, as I usually just tell my clients, I just say go based off your gross so that you give yourself that wiggle room. If you do get a pay increase, not only a pay increase, if you get, let's say you get a bonus, let's say you're at $200,000 and then you're married filing joint, let's say you and your spouse both work. That doesn't, and y'all don't plan on, let's say you're going to be at 200K after you get your raises for this year. So they just told you what you're going to be making in 2023, $200,000. That doesn't leave you much wiggle room as far as bonuses. All right, it's only $18,000 between the two of you. That's $9,000. And if y'all making, a 200K household, it's very, reasonable to say y'all might mess around depending on how well y'all do. They get, a few tens of $1,000s in bonuses. And some of y'all, you're not at the job, but bonuses can range in the thousands of dollars, on a quarterly basis. So let's say you get, a $2,000 bonus, every quarter was, 4 quarters in a year. That's 8,000. And your spouse get too. That's 16. Like that's right up on it. So that's something you need to be mindful too. Again, side hustles, all these different type of things. That's all going to get equated into, your gross, which obviously going to impact your AGI. Your gross is greater than or equal to your AGI. Your AGI is greater than or equal to your modified adjusted gross income. But to be safe, you can just always go off your gross. That's the most you're going to be putting on there from a tax return standpoint. All right, then the next thing is the HSA changes. Boom. Now, HSA, also known as a health savings account. Let me zoom in again. Boom. In short, this is an account where it is through your employer. First off, you need to have a high deductible health plan to qualify for an HSA, and you can't be covered by a health plan that doesn't allow you to have one. So if say you're covered by TRICARE, you can have an HP high deductible health plan, but you can't make use of the HSA. So if you're under a high deductible health plan, but your employer doesn't offer an HSA, you can go to a broker or HSA Bank or Fidelity, someone that offers HSAs, and you can contribute to it there. It'll be post-tax dollars, but you'll be able to take the deduction when you file. However, like I said, if you're under a healthcare plan that disqualifies you from, again, using HSA, not the high deductible health plan, then you can't use it. But again, so if you're single or individual, so I say it's an individual plan, not single. This isn't tax filing status. This is the health plan that you've selected. And this is where things get a little bit tricky, right? Because I have an individual plan, but my married filing status, my tax filing status is married. So it's going up to $38.50 for an individual. And then this is just letting you know the qualifications that your high deductible health plan has to meet. So even if you have a high deductible health plan, if the minimum deductible for qualifying high deductible health plans isn't $1,500, you can't do it. And the maximum out of pocket expense for the plan is less than $7,500. Excuse me, more than that, you can't do it. All right. And then for family, this is what it is: $7,750, $3,000, $15,000. And again, HSAs, if you're ever on some type of game show or anything where they're saying like, hey, what is the best, finance account or investment account or whatever, it's going to be an HSA because you get tax deferred, right? You don't have to pay taxes on this money. When you use the money for qualified health expenses by the IRS, you don't have to pay any taxes on it. And then depending on the plan that you have, you can invest the money inside the HSA, and then that money that you use as far as what you've invested and use that for any type of qualified health expenses, you don't have to pay any taxes at all on the gain. So you just get to skate taxes 3 different times. And one way to see, like, well, how good is this? Is look at what the IRS is telling us, or the government is saying what the contribution limit is on it. Okay, this is less than what the IRA one is. Remember, IRA is $6,500. This is $38.50. Okay, that's a big difference. So that lets you know, hey, this might be something to look into. But again, this is something from a healthcare standpoint, health insurance. So first thing when it comes to health insurance is, based on what your employer has, get the insurance that you need. And then if it so happens that it's, a high deductible health plan is something that works for you, and you have the money to invest HSA, then go ahead and do it. But definitely don't get a healthcare plan that gets access in HSA, but based off of the copays, things like that, or whatever it may be, you're not covered based on your actual healthcare and medical needs. That supersedes the HSA. It's a benefit if you're healthy enough to take advantage of it, but it's not going to make or break your wealth building journey, your financial plan, if you don't have an HSA. What will break it is if you got a whole bunch of medical debt, you're underinsured. Do not be underinsured. All right. Then I think the FSA. Yep, FSA is next. Oh, the main difference. Okay. For HSA, again, not only is that money, yours and everything I mentioned from the tax break standpoint, the money in the HSA is essentially your money. Like I said, HSA Bank, it's like a bank account that is yours for your healthcare expenses. Unlike the 401k, which is really like your employers that they manage for you, the HSA is yours as soon as you open it up. So even if your employer makes contributions to it, like I talked about earlier, that contribution limit, let's say your employer is going to contribute $500 to your HSA, the most you can put into it is going to be less that $500. So in this case, for next year, $3,350. Then your employer is putting in $500 to get you that $38.50. It's not like the 401k where your employer's contribution is not included in the contribution limit. For HSAs, the maximum money that can be put in there in a year is $3,850. So be mindful of what your employer may be putting in there. And then, because I just updated mine, when you do your form, it should, have it on there, say, hey, how much your employer putting in there. Make sure your contribution is, less of what your employer is putting in there. But for HSAs, that money stays there. So even when the year ends or your plan year ends, it's not use or lose for that money. You still get to keep it. And it can just roll over, and you leave your job, it's still yours. Again, like I said, you have that money invested, it's just always yours. Unlike the FSA, where when your plan year ends or the year ends, you have use or lose. So if you don't use that money, it's gone. Okay. And then for the FSA, the contribution limit is $3,050, up $200 from 2022. And it's saying the carryover maximums. And again, for the FSA, what was I going to say about the FSA? Oh, the FSA and the HSA, as of now, they have the same uses as far as the medical expenses. So if you have an HSA, you have an FSA, you're looking at them, you know which one to pick from a tax standpoint as far as using the money you put away for these two accounts. You get to use the money for the same thing, so there's no loss there. All right. And then, oh, am I showing y'all this too? The next one up, we got 2 more tabs left, y'all. Is, come on, the gift tax limit. Okay, so we talked about gift taxes before. So gift tax, in short, is you can gift someone money, and as long as it is under, Jesus, where is it at? There's just so much stuff. There we go. Boom. There we go. $17,000. So 2022 was $16,000. So in short, you could gift or give someone $16,000 or less. Ooh, excuse me. And the IRS was not requiring you to tell them about it. I believe it's this form up here. Like, look at all these changes. Oh, that's the estate changes. No, it's not that. And you wouldn't have to tell them. So if I were to give someone, this is an example, this is not really happening, but if I were to give someone $16,000, I do not have to tell the IRS about it. I'm good. But if I give them $16,001, it is on me to notify the IRS that I've given someone a gift over the gift tax limit. All right. And this limit is now going to $17,000 for 2023. However, and this is where things get tricky, and this is why you just kind of got to understand how things work out and be clear on what you're reading. Even if you're married filing joint, the gift tax limit of $17,000 applies to you and your spouse, right? So it's not like y'all get a total for your tax return because you're married filing joint of $17,000. You each get a $17,000 gift tax limit. So that's a total of $34,000 if you're married filing joint. And not only that, this $17,000 limit is per person you give it to. So you can give $17,000 up to 2 different people. It's not a total amount of what you gift people of $17,000 is per person. So if you find 10 people and you want to give them each $17,000, by all means. But again, you got to be careful of, gifting people money, because if you do gift someone too much money, I believe it's going to get deducted from, what is this called? Your estate limit. So I guess this year, my goodness, it's $12,920,000. So in short, if you give someone, let's say you give someone $20,000, right? So that's $3,000 over the 17K limit. That $3,000 is going to get deducted from your lifetime estate exemption of $12,920,000. You got a lifetime limit, and these things can change. To my knowledge, as you can see, it's in the 5 million range right here. But then when Trump became president, he upped it to roughly, $11 million. When Obama's office is in 5 million. I'm not sure if this is supposed to just continue to increase, for inflation, or based on who's in office, this number is what it is. So that's what you have to be mindful of as well. That's why I said before, in short, you're really going to have to truly key on your estate planning if you're over $10 million, because you can see right here, right, over 5 million, then, because this number is per individual. So if you're married, you double this number. So if you're married for right now, 2023, it's, over $25 million for your estate. But when Obama's office, or if it were to get changed back to this $5 million range, it's going to be $10 million for your estate. So obviously you want to plan on the safe side of that $10 million. That's something you got to be mindful of. Okay. And then the last thing, last but not least, but something very key, is the tax withholding estimator. Okay. So for this tax withholding estimator, what you can do is come here and put in your tax information. And this is on the IRS website, so it should be, slightly accurate. They do give you a big disclaimer that it's not 100%, but you can get, some planning going as far as seeing if you may owe, or if you're going to get a refund for this tax year. So you can come here, you can imagine, right, just, fill in all this information, right? Right, just fill in all this information. Okay, and you can put your salary in here, your hourly, all your hourly, whatever it is, all this stuff, everything that you get, and then eventually you're gonna get towards the end. They're gonna let you know what they're expecting for you to get as far as either on the refund side, or if you're going to owe them money. You're obviously going to need your pay stubs, right, from your jobs. If you're married, filing joint, you're going to need your spouse's information as well, right? They're going to ask you about the credits and things like that you may get. You're going to be able to put all of this in, again, like I said, on this tax withholding estimator. Okay, so this will help y'all get a head start on planning and preparing for your filing your taxes in 2023. Oh my goodness. Shout out to the fact that I did this the first half and there's no audio. All right. Let me stop sharing my screen. Boom. All right, y'all. That's it. Those are the major changes. Went over, but I didn't go over budgeting. Okay. It was on mute the whole time, so I'm gonna have to edit that out. But we did the budget again: necessities, debt payments, investments, lifestyle. You need to prioritize your budget. Okay. That's going to be the main thing you need to do to prepare yourself for 2023 and all the years beyond, and for all your financial goals. Okay. Take your income, subtract your expenses in the form of necessities, debt payments, investments, lifestyle. Income minus outgo equals leftover. However much money you have left over, that's what you're going to be able to use to hit your savings goals, your investment goals, vacation goals, debt payoff goals, debt management goals, building your credit score, house down payment, whatever it is. That's what you are going to be able to use to hit those goals. If you don't like the time it's going to take you to hit those goals, you either need to make more money or decrease your expenses, but you can only decrease your expenses but so much. However, remember, don't ever think that increasing your income will outweigh your ability to manage the income that you have. Money management over increasing your income. You need to increase your income, right, and lower your expenses, but you need to be able to manage your money. Always remember, millionaires go broke. Then we went over the 401k, the tax bracket changes, right? Still the same marginal tax rates, 10%, 12, 22, 24, 32, 35, 37%. Still those marginal rates. However, the ranges are increasing, and per the IRS website, these are tax inflation adjustments. Okay, so these are going to be adjusted for inflation. And again, like I said, if you are living paycheck to paycheck, if you penny pension, if your butthole, as my coach said in high school, don't get a tight butthole. If your butthole getting tight, as far as you trying to make ends meet, it's not going to be a large increase, but it's not going to be a large increase, but it's going to be some increase as far as how much money you're getting. If you're not, if you're not getting a raise, it's unfortunate, but you're not getting a crazy large raise. But even if you are, you're going to see a little bit more money in your check due to these ranges increasing from the tax bracket standpoint. Now, again, like I said, 401ks, again, the limit is going from $20,500 to $22,500. So a $2,000 increase. That's for 401ks, 403bs, most 457s, and TSPs or thrift savings plans if you work for the government. If you're 50 and up, and again, it's the year that you turn 50. So even if your birthday's on New Year's Eve next year and you're turning 50, if you're born, was it 1973? Yeah, if you're born in 1973, okay, you can put up to another $7,500 from a catch-up contribution standpoint into your 401k. So that's $7,500 plus that $22,500. That's a total of $30,000 that you can put into your 401k if you're 50 and over. So if you're born in 1973 or before, starting in 2 days, January 1st, you can put in $30,000 in that 401k. From an IRA standpoint, the annual contribution limit is going to increase from $6,000 to $6,500. So that's a little over $540 a month. You want to budget out, max out your Roth IRA that you can contribute to IRAs in total. Again, that's a total IRA contribution limit as far as traditional IRA and Roth IRA. So an even split would be $3,250 that you can put into a traditional IRA and a Roth IRA max. Okay, so you can't put $6,500 in both. You cannot do that. However, if you're married, filing joint, even if your spouse does not work, you can still put $6,500 in your spouse's, called a spousal IRA spousal Roth IRA, even they do not work, because since you are married, filing joint, it's essentially y'all's income. That's how the government looks at it. And since they have a taxable income, they can put money into the Roth IRA. Then if you're 50 and over, the catch-up contribution limit is still going to be $1,000. It's not increasing. So the most you can put into the IRAs for traditional and Roth is going to be $7,500 if you're 50 and over. And again, when I talked about simple IRAs are not the same as traditional or Roth IRAs. Simple IRAs are going to be more on the 401k side of the house, an employer sponsored plan. All right. The next thing I went over is not only the contribution limits, but the phase out ranges and the rules around traditional and Roth IRAs. Again, traditional IRAs do not have an income contribution limit, as far as saying once you make too much money, you can no longer put money in a traditional IRA. That is not the case. They have income contribution limits from a deduction standpoint. So traditional IRA contributions can be deducted from your income when you file your taxes, but that's up to a certain amount of money that you make. And they neglected to let me know what that number was on the IRS website on the page I was looking at. So I'm not sure what it is, but my guess is it's going to be somewhere around the same range it is for the phase out range for Roth IRAs. So again, 22-24% tax bracket issues for you. So if you're 12% or under, this is not something that's going to probably impact you. Now, if you are in the phase out ranges for the Roth IRA, again, $218,000 to $228,000 if you're married, filing joint, and this is based off of your adjusted gross income, which is likely going to be greater than or equal to your modified adjusted gross income. Again, get with a tax professional. That's the phase out range for married, filing joint. So if you make $218K or less in your MFJ, you can still max out both of your Roth IRAs. However, once you get into the 218 to 228K range, that's the phase out range where as you go through that range, you have to contribute less money or a reduced amount to your Roth IRA. And then once you get over the phase out range, that 228K, you cannot put any more money directly into a Roth IRA. Now, you can still put money into a Roth IRA, but you have to do the backdoor Roth IRA. And you do that by doing a traditional IRA, putting your contributions in that. Because remember, traditional IRAs have no income contribution limit. And then essentially you pay those taxes right then and there when you roll them over into the Roth. And then for those same general rules apply. But for single, the people filing status, head of household, and married filing separately, and you did not live with your spouse at any time during the year. I love that whole saying. But the phase out range for single is $138 to $153 for Roth IRAs. All right. Then we went over the HSA increases, $3,850 for an individual plan, $7,750 for a family plan. The FSA is going up to $3,050. Again, the major difference between HSA and FSA is HSA money can be rolled over, as far as you don't have to, there's no use it or lose it for the plan year. So even after a year goes by, that money still gets to stay in the account, versus an FSA, that money does have to be used, roughly speaking, within the year / the plan year. I think it ends like in November, something like that. But if you put, this $3,000 into your FSA and you don't use all of it, it's going to all be gone. Versus an HSA, if you were to max out the $3,850, it's not going to all be gone after a year when your plan year ends or whatever, right? Your employer lets you know, / the IRS says. And then the HSA and the FSA. So like, what I'm about to say, HSA and the FSA, the contributions that you put in there, they are tax-free if you use them for qualified health expenses, and they have the exact same qualified health expenses per the IRS. Then we got the gift tax limit. It's going from $16,000 to $17,000. Again, if you hit over the gift tax limit, it is on you to let the IRS know that you did that. It's not, the IRS is not going to know, quote unquote, but they're not going to know that you gifted someone over the gift tax limit. It is on you, and they tell you it is on you, that you have to fill out a form when you file your taxes to tell them that you gifted too much money. And then the last thing is the tax withholding estimator. So you can use that. Go to the IRS website. Let me see what I Googled exactly. I Google tax calculator IRS, and you want to click on the tax withholding estimator, and you'll be able to put in, your paycheck information, your tax filing status, any credits that you plan on getting, deductions, et cetera, charitable contributions, all these different type of things. And at the end of it, the IRS calculator is going to shoot you out an estimate. It's not guaranteed, but an estimate of how much you might owe, or how much you may get refunded. So that can help you get a head start. For some of you, if you have always been owing, this is a way for you to go in there and say, hey, let me get a month and a half head start on figuring out how much I'm going to owe on my taxes. So you don't have, taxes are due, I think, April 18th this year, or is it April 15th? Let me see when it is. Yeah, they're going to do April 18th this year. Yep, April 18th, Tuesday, April 18th. You're going to, give yourself at least, a 4-month head start on how much money you have to put aside for your taxes. But all right, y'all. Look, I still got to like and share. Again, make sure you hit that like button for the YouTube algorithm. Make sure you share and subscribe as well. If you have any questions or concerns, please leave comments. For those of you listening on the podcast platforms, please leave rating reviews. We need your help on the algorithm. We do see that I'm going to keep saying this stuff because we do see the numbers going up. So I'm going to keep saying it for those that hate me saying it. Okay, tough luck, but it works, as all the YouTube people say. Again, I'm Silent_Cory, Twitter, Instagram, and TikTok. My information is in the show notes on the YouTube videos. My co-host Stop Stalling Jay is on Twitter, Instagram, and TikTok as well. And his business page is FinallyFit on Instagram and Facebook. Then his website is FinallyFit.live. Again, Jordan is going through a rebranding process for FinallyFit. He will be offering beginner classes on Tuesday and Thursday. Again, classes are 5:30 a.m. 5:30 a.m. But he's also just so you know, don't get shocked. But he will be offering beginner classes for those of you you don't think you may be ready for the Monday, Wednesday, more intermediate advanced classes. He will be offering that as an option. Not to mention, you get access to the drive as far as previously recorded classes. You get a monthly check-in with Jordan. You get, I think he said, this dietary advice. I'm trying to remember what he had on the website, but you get a lot of stuff from Jordan. Okay, for this. So please check out FinallyFit.live. Jordan, unlike me, Jordan has a certification. I have no financial type of certifications outside of the fact that I was a teller for over half a decade. But Jordan is, what is he? He's the NASM. He's a certified personal trainer. I think that's a certification, but Jordan does have a certification. So it's not like he's just out here doing this stuff. He is trained in this. So you are getting real and great advice from someone who is a trained professional in this. Okay, he's literally giving you his professional opinion when he's on here from a training standpoint. Again, all of our information is in the show notes. For me, for my financial coaching information, it is there as well. $50 for one hour session a month, or $100 for up to one hour session a week. If you have any questions, concerns, again, feel free to reach out to either of us or leave a comment. But let me see, what's the next thing I have on here? It's the wrong one. See, there's so many things on here. I be getting lost, y'all. Oh, boom, that's it. All right, y'all. So again, tomorrow, and also too, my apologies for being radio silent for the first damn near 30 minutes on here. Tomorrow I'll be going live again to do, I don't even know if it's a recap, because I thought the student loan forgiveness would have occurred by now, per Joe Biden was going to. But I'll be doing a general recap on the student loan situation, how we got here. That's sort of going to be, real quick. But who has a student loan debt? Who's impacted by it? How do they get it? Why do they still have it? What's the reason college costs as much as it costs? Is college actually expensive? What degrees are people getting, et cetera, how to pay off the debt? How do we, in short, fix the student loan problem? And are people really right for complaining about what they're complaining about? Because at some point in time, we got to look at this data and see what people are doing. So I'm going to go over that tomorrow. Again, I believe it's going to be probably 5 or 6 p.m. I will do another Instagram post just to give a heads up. But again, hit that notification bell on the YouTube channel so you get alerted when I drop a video or we drop a video and either of us go live. And I also did remember, Jordan owes y'all, I did episode 14 and 15 for finance only topics. Jordan owes y'all some fitness only topics. I remember to tell him that and make sure we get to start working on that so Jordan can give you all that fitness only information. Because Jordan, and you talking about somebody that's cooking up, Jordan's been working on that since he might have been working on that crap over a year. I think he started working on I did mine, and I did mine in 2021. I think. Yeah, I did mine when we first started. So yeah, Jordan might have been working on that over a year. So I'll make sure you get that out to y'all. But all right, y'all. Appreciate y'all for tuning in. Again, apologies for the audio being muted the whole time. Gemma, as always, you got my back, which I truly appreciate, as you know. But thank you for letting me know the audio was not working, because it would have been muted the whole time, and I would have been extremely upset. But good thing it was just on the budgeting part, which, you know, if you've never listened to the episode, I go over the budget many a times. But all right, y'all, remember to save more and say less. Keep making better your best. And I will catch y'all in the next one.